Our presidential cycle pattern is derived by just taking the stock market data, chopping it up into 4-year chunks, and then averaging them together to see what normal looks like. You never get the market replicating it identically, but you know what normal's supposed to be, and you can see how it's behaving relative to that. Normally, right before the midterm, you get an October bottom, and this time, the stock market waited until the very last minute to get all its work done. We had a big sharp decline in October rather than the normal slow decline, but it got the bottom in on schedule, and now we're starting the 3rd year of the presidential term, which I say starts in November, and that's typically always an up year, always a bullish year, very strong pattern because we're no longer worried about the midterms, you're no longer worried about what might happen, and we can get back to business and let liquidity flow.
Right, here's the second chart, which does show really a pause following the election going into the middle of the month.
Right, and that's the same comparison. It's just zoomed in on the local data right now. And there's that little soft spot right after the midterm, bottoming about the middle of the month of November, and then the uptrend starts and continues on into next year. And so far, we're following the dance steps very closely.
Tom, is there any reason to believe that maybe you could see a deviation in this chart this year? And I bring that up because we had Mark Mobius on Closing Bell yesterday, and he made the point that maybe this would not be, with the Dems taking the House, that maybe this would not be good for markets moving forward, because what we've seen in the first 2 years of the Trump administration was deregulation, tax reform, some of these other more business-favorable policies that allowed stocks to rally as much as they did. Is there any reason to think that it could be different this time?
Well, anytime the market's doing anything, whether it's supposed to do it or not, you can get a wild event like the Ebola panic or Brexit that can come along and knock it off track. And usually when that happens, the market will steer extra hard to get back on track. The two fundamentals that really matter for the overall stock market is, number one, how much money is there? And number two, how much does that money want to be invested? Well, the wanting to be invested part is what we've been struggling with everyone's angst about the midterm election. Now that that's gone by, they don't have to worry about the unknown risk of how that might turn out, and they can get back to putting the money that exists back to work. The unknown is how much effect the quantitative tightening from the Fed, the QT, at $50 billion a month is going to suck enough money out of the system to make whatever anyone's desires are, make that irrelevant, because there just may not be enough liquidity to go around. So that's why we'll be looking for confirming signs from breadth indicators to say what the liquidity is doing. And so far we're seeing very strong indications from breadth numbers. The McClellan oscillator went up over 200, over plus 200, very high reading, and that says there's strong initiation of the new uptrend, and that's good news for the bullish case.
So given all that, Tom, we've been showing viewers a mystery chart of what the most important stock is to the market as a whole. You want to unveil the curtain on that one?
Well, the issue is about Apple and how it behaves relative to the other stocks in the stock market and relative to the indices. The price of Apple, I think is what you're talking about. It did not make a lower low in October like the NASDAQ Composite and the NASDAQ 100 did. And so when you see a divergence like that, when there's a disagreement, Apple usually ends up being right about where both are headed. Now, GE used to do that role when you compare GE to the Dow Jones Industrial Average, and if the two disagreed, you wanted to listen to GE. It was right about where both were headed. That stopped working about early 2017 when GE started this big plunge that is still going on now, and it's down to single digits. It's no longer performing that bellwether role. Apple seems to have taken it over. Apple is an important stock at $1 trillion market cap. It's bigger than all but 8 of the countries in the world's total market cap. So it's a big thing. And right now it's disagreeing with the lower low in October that we saw. And that's a bullish setup that confirms what we're expecting to see going into the 3rd year of the presidential term.
Tom, I understand how that works in retrospect. It's very good, interesting work, but extrapolating that out, I mean, does that mean that the iPhone is the most important product in the world? As goes the iPhone, so goes the entire market?
Don't confuse the company with the stock. The two
well, but the
are tied
iPhone
together,
is
but they're
very
not
much
the same
what
thing.
drives
So
Apple's stock price. I mean, it's
I understand, but people
large
wanting to be
majority of the
invested
revenue
in
and a
Apple.
larger majority of the profit.
Yes, but you're focusing on the company. it's what investors do with the stock that determines the path of the stock price. And if you see Apple starting to head lower in ways that the NDX or the NASDAQ composite or the Dow are not doing, and Apple starts being the leader to the downside, that's when you want to worry about the prospects for the overall stock market. We're not seeing that. We're instead seeing a bullish divergence where Apple's acting stronger, and that has positive things to say about the prospects for the stock market going into 2019.